Support and resistance levels play a crucial role in understanding price movements because they represent the key zones where the market has historically reacted, either reversing direction or pausing before continuing its trend. These levels act as psychological benchmarks that reflect collective trader behavior, institutional order placements, and supply-demand dynamics. Support is the price level where demand tends to be strong enough to prevent the price from falling further, often leading to a bounce or reversal upward, while resistance is the level where selling pressure overcomes buying interest, causing price to stall or decline. Traders use these zones not just as reference points, but as decision-making tools to predict future price action with greater accuracy. By analyzing how price reacts to these levels, whether it bounces, consolidates, or breaks through, traders can identify potential entries, exits, and stop-loss placements more strategically. Price often oscillates between support and resistance in a range-bound market, and once these levels are breached, they often switch roles. Previous support becomes new resistance, and vice versa. This phenomenon is deeply tied to trader psychology, where broken levels are retested due to emotional responses like fear of missing out or expectations of trend continuation. These levels also help filter out noise in the market by highlighting areas of true market interest rather than random fluctuations. Support and resistance are even more effective when combined with other technical tools like trend lines, moving averages, candlestick patterns, and volume indicators, as they help validate the strength or weakness of a price move. In trending markets, traders look for pullbacks to support in an uptrend or rallies to resistance in a downtrend to join the dominant direction with minimal risk. Additionally, understanding these levels enhances risk management by providing logical zones for placing stop-loss orders and setting realistic profit targets. Many breakout strategies also rely heavily on identifying strong support or resistance areas that, once broken with volume and momentum, signal a significant market move. Moreover, institutional traders often place large orders at these levels, creating visible price reactions that retail traders can use to align their trades with the market's larger forces. Support and resistance analysis also gives traders a contextual understanding of price movement, rather than relying solely on indicators or algorithms. It adds a layer of market awareness that is essential for price action trading. Without these reference points, price movement can appear chaotic, but once support and resistance zones are identified and respected, the market starts to reveal a pattern, making it easier to forecast direction, strength, and timing. Therefore, mastering support and resistance is fundamental for any trader who wants to understand price behavior deeply, minimize risk, and build a strategy grounded in real market dynamics rather than random guesses.